Okay, welcome Ioto to the latest episode of the European Tech Show. It is amazing to have you. How are you doing?
Yeah, doing well. So I'm very excited to be on here. I've been following your journey for a while now. So great to see your progress, and I know you've been following Mainsets as well. So happy to chat about it.
No, absolutely. Thank you for being here. Before we kick in, why don't you give me a quick 1 or 2 minute intro into both yourself and what you're building at Mainset?
Yeah, happy to. So I'll start with Mainset. Mainset is a multi-stage fintech-focused investor, investing across 5 sub-verticals of the fintech ecosystem, which we define broadly. So neo-banking, neo-lending, payments, wealth and capital markets, insurtech, office of the CFO, and tangential businesses to that. Multi-geography with a preference or a focus at the moment on Europe. We have coverage through our core team that sits in London, and then we've got 8 venture scouts and venture partners strategically located across the globe and in sub-verticals we're investing into. As for myself, I'm financial services and fintech backbone of my career, so I've been an operator, and that's a common theme amongst the individuals working in Mainset is we've got both investing and operating experience. I've run a fintech treasury, worked in large bulge bracket banks, smaller financial institutions, so and now building Mainset, and so really can live and breathe the founder journey. Gives me deep empathy for what they're going through, what they're building, but also bring a hugely analytical background and deep financial experience to the investment process.
Amazing. So Mainset, multi-stage European fund focused primarily on fintech. By multi-stage, what do you mean? How early, how late does Mainset go?
Yes, I mean the common theme it's post-revenue businesses, and we define it as late C to early C. The thematic that we're investing behind is a couple of things, but we're effectively in. If I was to take a horse racing analogy and say like right race, and then right horse, the horse is post-revenue. We believe that it's got product market and more importantly economic profit fit. So what does that mean? It means that it has. It's not selling £10 notes for £5. It is able to capture value and then at the right point in time, accrete that to free cash flow generation. So that gives you a sense. And the reasoning behind being multi-stage is we think that alpha generation or risk-adjusted returns are not equally and always the same static across stages. And so you might have a huge amount of excitement sitting in the earlier stage opportunities, which naturally bid prices up, and we like then the flexibility to go later where we believe there's a greater value to price disconnect.
Amazing. And so you are in the midst of raising your first fund now. What's that been like?
It's as I think most people listening to the show will know, it's an incredibly difficult fundraising environment, both for the GP and for founders building. It depends, I suppose, if you have AI at the end of your web address, it might make things a little bit easier. But we've been fortunate in that we went out to market in Q4 of 2024. We're looking to raise a £40 million fund, and we held first close in Q1 of 2025. It feels like from the outside that it's a short amount of time and a clear success, and all credit to the team for the incredible work they've done. But we've been quite incremental, so in terms of building Mainset out over the number of years, building relationships with our LP base through our SPV program. They knew us. We had stuck to what we said we would do. We did it on time. We had a really high-performing C portfolio, so happy to report that was top decile across performance metrics, IRR, TVPI, and I think most importantly DPI. So we've got a DPI score of metric of 0.33, and the top decile is at 0.1 per cohort. Carter's most recent cohort of 2,500 managers. Not to say that makes things easier, but we weren't effectively just selling a sizzle there. We had a stake, and I like to think that the stake was relatively attractive.
Amazing. And going out to market, trying to raise a first-time fund, focus on European fintech. Overall, kind of what are the key things that you came up against? Why were people either excited or not excited about this space right now?
I mean, I think fintech has been a bit out of favor for a while. We rightfully, or we respectfully disagree with that. Through logical reasoning, if we think that innovation is going to remain the same, or if not accelerate. Financial services will be large and ever increasing parts of the overall economy, and then by natural logic, there should be huge opportunity to invest into these innovative financial services companies because of fintech over the next decade. And I think we've seen that sentiment change. With public markets opening, there's been a number of IPOs, fintech IPOs. We're seeing interest in the market for secondaries. I mean, just most recently, Revolut, and the interest in acquiring secondaries in those assets. So we actually didn't dislike the fact that it was seen as slightly out of fashion because it presented interesting buying opportunities for us. And we do enjoy being in empty rooms. Look, I think the bar is higher, and the bar is higher for everyone. We weren't surprised by that, though. We expected it to be difficult. We didn't go into this with closed eyes. We were quite open-eyed in it, and I do think, Seb, it should always be difficult if you're managing other people's money. And that's the thing about Mainstream. We've been institutional from day one. We're a spin-out from a larger organization, and so we've had the luxury of being investment grade or institutional grade from day one, and that's how we built. And maybe that goes back to, in terms of the fundraising process, we knew we would be scrutinized by sophisticated investors, and we built Mindset accordingly.
Yeah, amazing. Fintech, kind of as you said, is maturing. It's been around for a lot, but there's still a lot of innovation happening. What are you seeing in the fintech market right now?
Maybe I'll talk about thematics, and then I can bring it down to specifics. So at Mainstream, we're quite interested in a couple of overarching themes, and then I'll bring it back down to maybe some verticals. One of the overarching themes, if I think about the evolution of fintech, was previously it was around competition. They were going to come in, eat everyone's lunch. Banks weren't kind of, the incumbents wouldn't be around. Insurance would be completely disrupted, and we haven't seen that play out. What we are seeing now is more a case of collaboration as a go-to-market strategy. And I do think that's a really interesting proposition because it leverages the best of both worlds. It leverages the fintech's ability to innovate, get to market quickly, build product, and it leverages the incumbent's deep balance sheet and effectively its ability to pay, and acknowledgement that maybe a buy versus build strategy is not the worst strategy to pursue for them. And I think a large incumbent financial services are now more open to partnering with innovative startups, and so we're seeing that as a potential shift. Obviously, well, not obviously, but I mean, Mainstream is particularly interested in boring, complex businesses, and we think the architecture of financial services is being retooled and being laid down for the next 25 years. On-prem, monolithic, non-API, non-cloud native infrastructure is being replaced by its opposites, and we're interested in the tooling that will provide that. I mean, as an example, within the insurance space, we expect insurers to spend around $1 trillion over the next 8 years just retooling the tech stack. Wow. And then thereafter spending around $200 billion a year just on the IT. So there's a huge opportunity there. It's not a secret that maybe insurance has been one of the slowest along wealth management to adopt technology.
Interesting. Okay, and so how are you, I guess, like, what's your edge in going out and finding some of these companies? Because I know you mentioned that you have like 7 or 8 scouts across Europe. Is that how you are kind of getting some of your deal flow in? How are you embedding yourself in the ecosystem to find these companies that are going to ride that next wave of disruption?
Exactly. I mean, if you're, when deciding on what Mainstream would focus on, we looked at what is the skill set of the house, what is the skill set of the team, where do we think the opportunity set lies, and that Venn diagram neatly overlapped over fintech, and it's just convenient that I've been doing that for the majority of my career. So being sector specialist narrows the scope in terms of where we look. It also increases the signaling to prospective investment or portfolios. They know we're speaking their language. We understand what they're saying. It's refreshing if they're getting on a call and not having to explain, basic terms, non-performing loans, loss ratios, total expense ratios. So, we've lived and breathed their pain points. So that makes it a much more easier conversation to be had. That being said, in all things in mindset, we first and foremost start to learn. And so there's in-house proprietary frameworks and tools that we use. For example, Podium is a in-house created piece of software. We ingest a huge amount of information to quickly inform our yes/no investment decision. And then we embed ourselves within the ecosystem, hosting events, being thought leaders, appearing on shows like this to increase our reach. And people are starting to appreciate us for and thinking about us as the fintech investors to go to when they're waiting a partner who has lived and breathed what they're currently building.
Yeah, amazing. And that makes total sense. I think there's a real, we're seeing a lot of VC funds raise these huge mega $billion rounds, whatever. And I think there's going to be a real market for strong niche emerging managers to really add value to their vertical. So I think it's really exciting.
Exactly on that, you've got to think about like what is your value proposition to both. I mean, in the main sense, we think about it, we have two customers effectively. We've got our founders who we need to serve, and we've got our LPs who we need to serve. And stacking odds in our favor, I think, is a common theme. And being sector or being specialist, being small, and being emerging actually are all attributes of alpha generation or outperformance. And I think the day of maybe trying to raise a generalist fund as fund one or fund two, I think it's really challenging. It's difficult to compete with the brands that are out there, and you've got to show your edge.
Yeah, absolutely. I want to ask about the fundraising, I guess from a founder perspective across Europe, the fundraising environment. We've seen a lot of changes in the last 5 years, the end of 0% interest rates. We're seeing the Ukraine war affect defense. We're seeing the rise of AI companies. There's been a lot of very rapid changes across lots of industries and sectors. How have you seen this, if at all, impact fintech generally?
Yeah, I mean, obviously you can't escape the macro, despite the vertical. And I mean that holistically, and not just about geopolitics, but about innovation. And so I think, when we're looking at businesses now, they're either an AI business or they are AI enabled. And I think any business, and potentially maybe what we'll do is we'll look back in 10 years' time and say like, okay, we don't talk about internet businesses anymore. Every business has some kind of internet presence. And so in 10 years' time, every business will have an AI component to it, whether it be a full stack AI or enabled through AI. I think thinking about businesses, they're saying to themselves, how do we leverage this technology to optimize performance, either top in terms of revenue accretion or through cost optimization? I think they're thinking very carefully around hiring. How can they reduce it or keep headcount or maybe not make that next hire? I do think that's potentially impacting entry-level roles within organizations, and people are taking pause as they think to hire. But we are incredibly excited by the opportunity that any technological shift presents, and we're reflecting that in our portfolio. We've made a number of investments within AI-first businesses before it was cool, in the sense of the Sprout AI, which is a tool for insurers around claims management. Once again, highly complex, but not that exciting a business, and that's what we like, because it does present lower competition and thereby extension the ability for the portfolio company to price or capture some of that value, bringing it back to that idea around unit economics and being in the right race. And then most recently, our investment into Noon, which is the world's first agentic CFO.
Very cool. And I guess this is a good time to ask this question, but and maybe you can give some real context to Noom and why you invested. But let's imagine I'm a fintech investor and I want to raise money from Mainset. What have I got to prove to you to get you on board? And how did Noom do that?
Yeah, okay. I mean, I'll come back to the horse racing analogy, and not to say that we make bets, because we're high conviction, highly analytical, structured, framework-driven investors. But I'll use it because it's an understandable analogy. I think and I'll break it out between company and individual within that. So if we say to ourselves, top question is, do we want to be in this race? Is this an actual race? And that's understanding market structures and the ability of who captures value where. Because ultimately, we do want our portfolio companies to be able to generate free cash flow. I'm not saying that has to be today, but at scale. And so is this a race that allows for value capture by the organizations, or is that pulvered away or shared with a consumer, shared with a third party, whatever that third party may be. So are we in the right race? Then secondly, we're asking ourselves, are we in the right horse, or are we putting our money on the right horse? And that's an understanding of the fundamental building blocks of that business, and coming back through to unit economics, understanding, are you selling 10 quid notes for 5 quid? And then coming to the founders, are we backing the right jockey? And no surprise, once again, we've got a structured, framework-driven process to evaluate our founders alongside obviously gut, but also alongside empirical evidence that leads to, or that are shown to lead to our performance. So thinking through that is, what is founder product fit? What is the drive, or what is the speed to execution or speed to insight that this founder has shown historically? Because I know in investing we say past performance is not a predictor for future, but I believe in people it is. And so we look, what can we see as demonstratable around this founder or management team? Because it's not necessarily always just the founder who's driving the ship. You've got to understand, like, who is actually driving this business forward, and what do they demonstrate as their ability to speed to execution, speed to insight? Are they complementary? Why are they uniquely positioned to solve that problem? Bringing that back to Noom. Noom scored incredibly highly. It used to be Scale Up, and we've been tracking this business for a number of years and have had multiple engagements with the founding team. We had originally not invested in the business because we weren't excited by the race that they were in previously, being FP&A forecasting. I would think that's a challenging business to make money in. But the move to the agentic solution is incredibly interesting for us. So they had always previously tipped the founder the right jockey. The next thing they now tick is right race, and given the reasons there. And then lastly, the thing we think about within that analogy, obviously there's a huge amount more beyond that, but to keep it simple is, what are the odds? So, what is that? And the odds for us are understanding what is the structure we're investing into, what is the price that we're paying for this asset, and we do invest around this idea of price to value disconnect. And then we think about what is the correct sizing of this asset in relation to our overall portfolio.
Interesting. Okay, so you're actively seeking out opportunities where the price is attractive, not just the founder of the market. You want to make sure that you're getting in a good enough price that you can make a big.
I think totally, and I think so. Some people poo-poo that in terms of it didn't matter. I think the tide is out, and some people have been left swimming naked. I think price is always important. The fundamental and pithy statement to say, but the first principle of investing is buy low and sell high.
Yeah. Interesting. Yeah. Okay. You're a very data-driven organization. I think you personally and your team, very data-heavy, very analytical. When we've spoken previously, we've talked about the huge database that you have of data points tracking fintech companies across the world. I'm curious to hear what you think of is going on right now in both the public and the private fintech space. So we've seen a number of very successful fintech IPOs happen in the last couple of months, like eToro, Chime, Circle. They all IPO'd, very, very successful. They all seen huge growth since they IPO'd. So I would just kind of love to get your perspective on what you think is happening in the public world and in the public perception of fintech, and then similarly what's going on in the private world.
Yeah, happy to. And I mean, we don't invest in the public, but what we do is we track hundreds of listed fintechs and non-fintech traditional financial businesses. And 30 seconds on why we do that, because we think it's important to understand where publics are pricing and that private markets lag with a certain time period. And we need to understand, like, what are our businesses going to look like at scale? And by extension, what does that translate back into valuations that we pay for today? What does that business look like when it does hit maturity? What are the metrics it needs to get to, or what's market leading? So a huge amount of information that we can gain from public markets that help us become better private market investors. We track, and there's the Mainset Fintech Index, which is a circa 120 listed fintechs. That index is tracking year to date. This was as at 4th of June, so slightly, a couple of days, where are we now, 5 days off. But that was, I think, 16% year to date versus the S&P, which is around 7%, S&P 500, not broadly, and then NASDAQ broadly is around 9%. So significant outperformance of the fintech index, and that's consistent across 2023 actually and 2024, materially outperformed. So I think what you're seeing there is, okay, Some of that is that it was off a pretty beaten up sector in 22, but broadly we're now into our fourth year of outperformance. Coming back to you've hit it in terms of appetite for public market and public market fintechs seems to be in fashion, and that is a positive. That sentiment feeds over into private markets for a couple of reasons. One, I think people are seeing the outsized returns that early stage investors into the likes of Circle, Robinhood, eToro, Chime have made, and multiples of hundreds on initial investor capital. That's good for us, because what do we provide is we provide these investors with access to those early stage opportunities. You need to have fully dedicated team to be accessing this, finding them, diligencing them. They're not available on a public exchange. And then secondly, it shows a route to market for later stage opportunities. And we've seen we're looking at funding data. June in later stage funding has been really out of fashion because people were finding it difficult to, what's my exit route? Public market multiples were down, albeit on the rise. Now when we see public markets opening again, we're seeing investors become more excited about later stage opportunities. And then again, coming to this idea around MaidSet being multi-stage, we're completely aware that what does that do to the entry price for us, and that where else does that not present opportunities for us to invest?
And where do you think that presents opportunities? One of the things that's interesting is a lot of secondaries going on right now. Would MaidSet be interested in potential secondary purchases if the price was low enough?
For MaidSet to follow its investment process, often secondaries are challenging because we don't get access to the management team.
Interesting.
And so if your initial entry point is via secondaries and you can't follow, we've been presented with these opportunities many times, and we have to say to ourselves, what's important? Do we trust the process because the process seems to be working? Or do we shift our process and start buying secondaries but not be able to follow investment process? So far, Seb, what we've decided to is stick to the process. And I am quite focused on that. I said, don't worry about outcomes. Focus on the process. And then if you believe in the process, the outcomes will eventually follow. That being said, we have used secondaries as a means of doubling down on assets, which we are particularly excited by. We have a history with the management team. We've already gone through our whole diligence process. And then we use secondaries as a way to buy, to land and expand.
Interesting. So you just see it as a way of kind of going deeper, getting more shares in a company that you've already got conviction on.
But I can totally get the investment rationale for people going in and buying these secondaries. And I think when there's a shortened route to market, as you see with IPO market opening up, you kind of saying to yourself, well, let me buy these secondaries. I'm happy to take a 1.5, 2 times, 3 times multiple between now and potential IPO. I get it. But I think there are also enough use cases there where later stage investors, when it has come time for these assets to be priced in the public markets, they've seen the inverse.
Interesting. Okay. So I guess for you, you can recognize the opportunity, but it just doesn't fit your investment process.
Not at the moment.
Makes sense. Look, I'm conscious that we're running out of time. I think one last question to wrap up. What's the one fintech trend that you are most bullish on at the moment?
Oh, I never want to pick just one, but I think this idea around the retooling of financial services for the next 25 years. Not necessarily who's going to be the next front end, but who's really building the infrastructure that financial services will run over for the next 2.5 decades. I think that's really interesting. It's also, it doesn't get a lot of airtime. It's not sexy. Yeah. People don't talk about it, and it's to most of the world, we don't even know it exists. But we think there's a huge investment opportunity there.
Yeah, and I guess that really fits your thesis of the classic, the boring stuff, right? It's the back end, the regulatory, the infrastructure, which a lot of people are not focusing on. Well, look, thank you so much for joining us. It's been a pleasure to speak to you. And I really appreciate you coming on the show.
Absolutely. Thanks for having me, Seth.